Just because a stock pays you a dividend doesn't mean it's a safe stock to own. In fact, some of the highest yields out there are ticking time bombs waiting to explode. And when they do, not only do you lose that sweet passive income, but the stock price usually crashes too. So today, I'm breaking down the best practices for evaluating dividend safety. The exact checklist that I use before I buy a dividend stock. If you follow these steps, you'll have a much better shot of building a dividend portfolio that pays you forever without any surprises. If you enjoy this type of content, just do me a quick favor. Please smash that like button so more dividend investors can see this video. With that being said, let's jump right into it. First up is the payout ratio. This is the percentage of a company's earnings that is being paid out as a dividend. A payout ratio under 60% is generally the sweet spot. It means the company is keeping plenty of its cash to reinvest and weather the bad years. If you see a payout ratio over 100%, that means that they're paying out more than they earn, which is usually a giant red flag. And here's a quick tip. For REITs in certain industries, look at the funds from operations, better known as the FFO, or you could also look at the cash flow payout ratios instead of earnings because they work a bit differently in those industries. Second, history doesn't guarantee the future, but it does give you a huge clue. A company that's been paying and increasing their dividend for 10, 20, even 50 years has likely built it into their corporate DNA. Dividend Aristocrats and Dividend Kings are prime examples of this. These are companies that have raised their dividends for 25 plus years and 50 plus years straight. If a company cut its dividend in the last recession, that's not automatically bad, but you should figure out why they cut that dividend before you invest in them. Third, a strong balance sheet. I can't stress this enough, guys. Look at the company's debt to equity ratio. A high level of debt can put dividends at risk when interest rates rise or earnings fall. Check their cash reserves. A healthy cash position can buy you time in tough markets. A company with a strong balance sheet can keep paying you even throughout an economic storm. Fourth, cash flow. Remember, guys, dividends are paid from cash, not from accounting profits. Go to the company's cash flow statement and check free cash flow. If free cash flow is negative or barely covering the dividend, that's your warning sign. Cash is like oxygen for your dividends. Without it, your payout completely suffocates. Fifth, know the industry. Some industries have built-in volatility. For example, energy. Energy companies can have amazing dividends in boom years, but oil prices can tank and wipe them out. On the other hand, utilities, consumer staples, and healthcare are usually more stable because people still need them in any type of economy. You want at least part of your portfolio in sectors that have a steady demand. 6, management's track record. Listen to some of their earnings call. If management talks about the dividend as a top priority in the business, that's usually a great sign. If they dodge dividend questions or talk about reallocating capital elsewhere, watch out for that, guys. That's usually a red flag. That's basically corporate speak for we might cut it in the future. 7th, look for dividend growth, not just yield. A 3% yield that grows 7% a year can beat a flat 6% yield over time. Dividend growth also signals that the business is doing well enough to increase shareholder payouts every single year. So here's the bottom line. A safe dividend comes from a company that has a sustainable payout ratio, strong cash flow, low debt, a history of stability, and a management team that's committed to rewarding its shareholders. If you check those boxes before buying, you're not just investing for income, you're literally building a paycheck that can last for decades. If you found this video helpful, drop me a comment down below with your favorite dividend stock, hit that like button for me, and also subscribe to the channel for more dividend investing strategies. With that being said, I will catch you on the next one. Peace.